We talked about where most Americans actually stand when it comes to retirement savings, and why so many people in their 40s and 50s feel behind. We covered the accounts, the strategies, the order of operations. We talked about sequence of returns risk and the bucket approach that protects you from it. If you have not watched part 1 yet, I recommend going back and starting there. The link is in the description. But if you are here, you already know the basics. And today we go further. Because here is the thing nobody tells you about building wealth after 40, the strategy is the easy part. The hard part is the person executing it. In this video, we are going to talk about the advanced tax strategies that can add tens of thousands of dollars to your retirement without changing a single investment you own. We are going to talk about the psychological traps that silently derail even the most disciplined investors, and exactly how to beat them. And we are going to talk about the global forces shaping your financial life right now, whether you are paying attention to them or not. Welcome back to Fortune Files. Let's get to work. Now I want to spend some time on tax strategy, because this is the area where intelligent planning can add the most value to your retirement with the least additional risk. Most people think about taxes reactively. They earn money, they pay taxes, they move on. But the investors who build and preserve the most wealth think about taxes proactively, sometimes years or even decades in advance. The most powerful concept in advanced tax planning for retirement investors is something called the Roth conversion ladder. Here is the problem it solves. Many Americans in their 40s and 50s have accumulated substantial balances in traditional 401k accounts and traditional IRAs. That money has never been taxed. And the IRS has not forgotten about it. Starting at age 73, the IRS requires you to begin taking what are called required minimum distributions, or RMDs, from those accounts every year, whether you need the money or not. The size of those distributions is calculated based on your account balance and life expectancy. And every dollar you withdraw is added to your taxable income for that year. For investors who have saved diligently, this can create a situation where retirement actually pushes them into a higher tax bracket than they were in during their working years. It is one of the great ironies of the American retirement system. The Roth conversion ladder is a strategy to address this problem before it becomes one. The basic idea is to systematically convert portions of your traditional IRA or 401k into a Roth IRA over a period of years, paying the tax on those conversions now, at today's rates, rather than later when rates may be higher and your RMDs may be forcing larger withdrawals. The ideal window for Roth conversions is often the years between retirement and age 73, when your earned income has dropped but your RMDs have not yet begun. During this window, your taxable income may be at its lowest point in decades. Converting strategically during these years can dramatically reduce your lifetime tax burden. There is another tax strategy that every investor over 40 with a taxable brokerage account should understand: tax loss harvesting. The concept is straightforward. When a position in your portfolio has declined in value, you can sell it, realize the loss for tax purposes, and immediately reinvest the proceeds in a similar, though not identical, investment. The realized loss can be used to offset capital gains elsewhere in your portfolio, or up to $3,000 of ordinary income per year. Done consistently over years and decades, tax loss harvesting can meaningfully improve your after-tax returns without changing your overall investment exposure. It is one of the clearest examples of a strategy that generates real financial benefit at essentially no cost to your long-term portfolio. And then there is the concept of asset location, which we touched on earlier, but deserves a deeper look. The principle is that different types of investments generate different types of taxable income, and those different types of income are taxed at very different rates. Long-term capital gains, profits from selling assets you have held for more than a year, are taxed at preferential rates of 0, 15, or 20%, depending on your income. Qualified dividends from stock funds are taxed at the same favorable rates. But interest income from bond funds and short-term capital gains are taxed at your ordinary income rate, which for many middle-class Americans is 22 or 24%, and can be significantly higher for higher earners. The implication is clear. You want your bond funds, which generate ordinary income taxed at higher rates, inside your tax-advantaged accounts, where that income is sheltered. And you want your stock index funds, which generate mostly long-term capital gains and qualified dividends taxed at lower rates, in your taxable brokerage account, where those favorable rates apply. This single organizational decision, applied consistently over 20 years, can add meaningfully to your after-tax wealth without changing a single investment you own. Let us talk about dividend investing, a strategy that becomes increasingly relevant as you move through your 40s and into your 50s and approach the income generation phase of your financial life. A dividend is a portion of a company's profits paid directly to shareholders, typically on a quarterly basis. Mature, established companies, think consumer staples, utilities, healthcare companies, and financial institutions, often pay reliable dividends year after year, regardless of what the broader stock market is doing. For a long-term investor in their 40s, dividends serve two distinct purposes. First, they provide a stream of income that can be automatically reinvested to buy additional shares, a process that significantly accelerates the compounding of your portfolio over time. Second, as you approach retirement, those same dividends can be redirected as actual income, reducing the need to sell shares to fund your living expenses. This matters more than most people realize. An investor who can fund 40 or 50% of their annual retirement expenses through dividends and interest without selling a single share is far less exposed to sequence of returns risk. Their portfolio can sit through a market downturn largely intact, because they are not being forced to sell at depressed prices. The most straightforward way to incorporate dividends into a portfolio is through low-cost dividend-focused index funds, funds that track indexes of high dividend-paying stocks across hundreds of companies. This provides the income benefit of dividends without the concentration risk of owning individual dividend stocks. One important caution: chasing the highest dividend yield is one of the more common and more costly mistakes in income investing. A stock with an unusually high dividend yield is often signaling that the market expects that dividend to be cut, because the stock price has fallen dramatically, which mathematically inflates the yield. Focus instead on dividend growth, companies or funds that have a track record of not just paying dividends, but increasing them consistently over time. A company that has grown its dividend every year for 25 consecutive years is demonstrating a kind of financial discipline and resilience that a high-yield number alone cannot capture. There is one more advanced strategy one want to cover before we move into the psychology section, and it is one that most investors know they should do but almost nobody actually does consistently. It is called rebalancing. And it is, quite simply, the act of periodically returning your portfolio to its target allocation. Here is why it matters. Imagine you start with a portfolio that is 70% stocks and 30% bonds. After a strong bull market, your stocks have grown so much that they now represent 85% of your portfolio. Your bonds are down to 15%. You are now carrying significantly more risk than you intended, not because you made any active decision to take on more risk, but simply because one part of your portfolio grew faster than the other. Rebalancing means selling some of the outperforming asset, in this case, stocks, and using the proceeds to buy more of the underperforming asset, bonds, to return to your original 70/30 target. This feels deeply counterintuitive. You are selling what has been winning and buying what has been lagging. Every instinct says to do the opposite. But the data is clear. Disciplined rebalancing, done on a schedule, not based on market predictions, forces you to systematically sell high and buy low. It keeps your risk level aligned with your actual financial plan. And over long periods, it has been shown to improve risk-adjusted returns for most investors. Most financial advisors recommend rebalancing once or twice per year, or whenever any asset class drifts more than 5 percentage points from its target allocation. For investors in tax-advantaged accounts, rebalancing has no immediate tax consequences. For taxable accounts, rebalancing should be done thoughtfully to minimize unnecessary capital gains, using new contributions to buy underweight assets rather than selling overweight ones wherever possible. Now, let us talk about the part of investing that no one wants to admit is the hardest part. Not the math. Not the account selection. Not even the tax strategy. The hardest part of investing, for every investor, at every stage of life, at every income level, is managing your own mind. In 2002, the psychologist Daniel Kahneman won the Nobel Prize in Economics. Not for a financial model. Not for an algorithm. But for his research on how human beings actually make decisions, and why those decisions so often work against our own best interests. What Kahneman and his colleagues discovered, across decades of research, is that human beings are not the rational economic actors that classical financial theory assumed. We are deeply, systematically irrational in predictable ways. And those irrationalities cost us enormous amounts of money, year after year, without us even realizing it. Let me walk you through the ones that matter most for investors over 40, because understanding them is the first step to overcoming them. The first and most powerful is called loss aversion. Kahneman's research showed that the psychological pain of losing $1,000 is approximately twice as intense as the pleasure of gaining $1,000. Losing and gaining the exact same amount do not feel the same to the human brain. The loss feels far worse. The investment implications of this are profound. Because loss aversion is the primary reason that investors sell at the worst possible times. When a portfolio drops 25%, the rational response, if you are a long-term investor with a decade or more before you need the money, is to do nothing, or even to buy more. History is unambiguous on this. Every major market decline in American history has eventually been followed by a full recovery and new highs. But loss aversion does not care about history. It registers only the present pain. The red numbers on the screen. The headlines. The feeling that things are different this time, that this time the market might not come back, that you should protect what you have left before it gets worse. That feeling has cost American investors trillions of dollars over the past century. And it will cost the next generation of investors trillions more, unless they consciously, deliberately, systematically override it. The most effective defense against loss aversion is not willpower. Willpower is finite and unreliable. The most effective defense is structure. Automate your contributions so that money moves into your investment accounts before you can see it in your checking account and decide to keep it. Set your portfolio to automatically rebalance. Establish a written investment policy statement, a 1 or 2 page document that outlines your financial goals, your asset allocation, and, critically, your plan for what you will do during a market downturn. Not what you think you will do. What you have committed in writing, in advance, to do. When the market falls 30% and every instinct is screaming at you to sell, you open that document and read it. And then you do what it says. This is not a glamorous strategy. But it is an extraordinarily effective one. The second psychological trap is called recency bias. And it is the tendency to believe that whatever has happened recently will continue to happen indefinitely. After a long bull market, recency bias tells investors that stocks only go up. It is why retail investment flows into the stock market tend to peak near market tops. Everyone has seen the market go up for years and cannot imagine it going down. After a severe bear market, recency bias works in the opposite direction. Investors who lived through 2008 watched their portfolios lose half their value. Many of them moved to cash and stayed there, missing the most powerful recovery in stock market history over the following decade. A study by Dalbar, a financial research firm, has tracked the actual returns earned by average mutual fund investors compared to the returns of the funds they invested in. The results, published annually, are consistently striking. Over the 20 years ending in 2022, the S&P 500 returned an average of approximately 9.8% per year. The average equity fund investor earned approximately 6.8% per year. The difference, 3 full percentage points annually, was not caused by fund fees or bad fund selection. It was caused almost entirely by investor behavior. By buying after markets had risen and selling after markets had fallen. By recency bias in action. On a $300,000 portfolio over 20 years, that behavioral gap costs you more than $400,000. Not because of anything the market did. Because of what you did. The antidote to recency bias is historical perspective. Not as a comfort, but as a discipline. When markets feel unstoppable, remember 2000 and 2008. When markets feel catastrophic, remember 2009 and 2020 and what came after. The pattern is not a guarantee. But it is a very long and very consistent record. The third psychological trap is overconfidence. And this one is particularly relevant for intelligent, high-achieving people, which describes most of the audience for a channel like this. Studies in behavioral finance have repeatedly found that the more financially literate and professionally successful a person is, the more likely they are to believe they can outperform the market through active stock selection or market timing. This belief is almost never justified by the evidence. A study of more than 66,000 individual investor accounts at a major brokerage found that the most active traders, the people who traded the most frequently, earned returns that were 6.5 percentage points per year below the market average. The investors who traded the least earned returns very close to the market. More activity, more confidence, more research, worse results. Less activity, less confidence, simpler strategy, better results. Why does this happen? Because overconfidence leads investors to believe they have an informational edge that they do not actually have. In today's markets, you are competing with hedge funds that employ hundreds of analysts, run proprietary machine learning models, and can execute trades in microseconds. The idea that an individual investor reading financial news and doing their own analysis can consistently identify mispricings that these professionals have missed is, to put it gently, optimistic. This does not mean you are not intelligent. It means the market is extraordinarily efficient at incorporating publicly available information into prices. And that efficiency makes consistent outperformance through stock picking extraordinarily difficult for anyone, including the professionals. The most rational response to this reality is not to give up on investing. It is to stop trying to beat the market and focus instead on capturing the market's returns as efficiently and cheaply as possible. That is what index funds do. And that, as Warren Buffett has said repeatedly, is what he recommends for the vast majority of investors. The fourth psychological trap is one that strikes closer to home for most people in their 40s. It is called present bias, the tendency to value immediate rewards far more heavily than future ones, even when the future reward is objectively much larger. Present bias is why people choose to spend $500 today rather than invest it to have $1,900 in 20 years. Rationally, the $1,900 is almost 4 times better. Psychologically, the $500 is available right now, and the $1,900 is abstract and distant and does not feel real. Present bias is why Americans spend more on coffee and streaming subscriptions and impulse Amazon purchases than they contribute to their retirement accounts. Not because they do not care about retirement. Because retirement is 25 years away and the coffee is available right now. The most effective strategy for overcoming present bias in financial decisions is to make the future feel more concrete and more immediate. One powerful technique is called mental time travel. Rather than thinking abstractly about your retirement finances, close your eyes and try to actually picture yourself at 70. Where are you living? What does your day look like? How do you feel? Do you have financial freedom, or are you anxious about money? This kind of vivid, specific future visualization has been shown in research to meaningfully increase savings behavior in the present. Another technique is the automatic escalation of contributions. Rather than committing to save more money now, which triggers present bias immediately, you commit to increasing your contribution rate by 1% every year, or whenever you receive a raise. The increase happens in the future, so present bias is less activated. But the long-term effect on your retirement balance is substantial. Research on these automatic escalation programs has consistently found that when employees are automatically enrolled in them, they stay enrolled, and their retirement savings increase dramatically compared to employees who have to make active decisions about contributions. The takeaway: do not rely on future willpower to make good financial decisions. Make the decision now, automate it, and remove yourself from the equation as much as possible. There is one more psychological force I want to address, one that is rarely discussed in financial content but that quietly shapes the financial behavior of millions of Americans. It is social comparison. The tendency to measure our own financial situation not against our goals or our needs, but against the people around us. Social comparison has always existed. But social media has amplified it to a degree that previous generations never experienced. You are now exposed, daily, to carefully curated images of your peers' vacations, homes, cars, and apparent financial success. And the human brain, which evolved in small tribal communities where relative status was genuinely important, cannot easily distinguish between a curated Instagram feed and reality. The financial consequences are severe. Americans spent more than $5 trillion on personal consumption in 2023. A significant portion of that spending was not driven by genuine need or genuine desire, it was driven by the unconscious need to maintain perceived status relative to peers. For investors over 40 trying to build financial security, social comparison is a direct tax on your future wealth. Every dollar spent to signal success to others is a dollar that is not compounding in your portfolio. The antidote is not austerity. You should enjoy your life. Financial security built on a foundation of joyless deprivation is not a life well lived. The antidote is intentionality. It is the practice of asking, before any significant expenditure, am I buying this because it genuinely makes my life better, or because I want someone else to see that I bought it? Is this purchase aligned with what I actually value, or with what I want others to think I value? The people who build the most wealth are almost never the people with the most visible signs of wealth. They are the people who made consistent, quiet, disciplined financial decisions for decades, and then, eventually, found themselves in a position of genuine freedom. The fancy car depreciates. The compound interest does not. Let us shift back to strategy for a moment, because there is an important dimension of late-stage wealth building that we have not yet addressed. It is the question of income diversification. For most of their working lives, most Americans have a single income stream, their salary or wages. That is an enormous concentration of financial risk. If that income disappears, through job loss, disability, or illness, the entire financial plan collapses. The investors who build the most resilient financial lives are those who, over time, develop multiple streams of income that are not all dependent on the same source. This does not mean you need to quit your job and start a business. Income diversification can take many forms, and many of them are accessible to any disciplined saver. Dividend income from a well-constructed investment portfolio is one. A portfolio of $300,000 in dividend-paying index funds yielding 2.5% generates $7,500 per year in passive income, income that arrives regardless of whether you are working, regardless of what the economy is doing, and regardless of whether your employer is having a good quarter. Interest income from bond funds and high-yield savings accounts is another. In today's interest rate environment, a $100,000 allocation to short-term Treasury securities generates approximately $4,500 to $5,000 per year in interest income with essentially no risk to principal. Rental income, as we discussed, can provide meaningful cash flow if managed carefully. Even a single rental property, a small condo, a single-family home in a stable market, can generate $8,000 to $15,000 per year in net rental income after expenses, depending on the market and the mortgage situation. A part-time consulting practice, an online course, a freelance skill, any income-generating activity that is not tied to your primary employer adds a layer of financial resilience that a paycheck alone cannot provide. The goal is not to become a full-time entrepreneur. The goal is to reduce the catastrophic risk of having a single point of failure in your financial life. Most Americans who experience genuine financial crisis do so not because the stock market crashed, but because they lost their primary income source and had nothing else to fall back on. We have covered an enormous amount of ground. And I want to bring it all together now into something concrete, a framework for what a real, sustainable financial plan looks like for an investor who is starting seriously in their 40s or 50s. The first principle is clarity of purpose. You need to know, with specificity, what you are building toward. Not a vague notion of being comfortable in retirement, but an actual number. How much money do you need to live on per year in retirement? At what age do you want to retire? What does your ideal retirement actually look like, in specific, vivid detail? A commonly cited guideline is the 4% rule, the idea that you can withdraw 4% of your portfolio per year in retirement with a high probability that your money will last 30 years. By this rule, if you need $60,000 per year in retirement income from your portfolio, you need $1.5 million saved. If you need $80,000 per year, you need $2 million. These numbers can feel overwhelming. But they become manageable when you break them into annual and monthly targets, factor in Social Security income, and give yourself a realistic timeline. The second principle is ruthless prioritization of savings rate. Of all the variables in your financial plan, investment returns, asset allocation, tax strategy, your savings rate is the one you have the most direct control over. And for investors starting in their 40s, it is also the most important. A person who saves aggressively, putting 20, 25, or even 30% of their income toward retirement, can build substantial wealth even if their investment returns are modest. A person who saves only 5% cannot build substantial wealth even if their investment returns are exceptional. This means looking at your spending with genuine honesty and asking where the money is actually going. It means distinguishing between lifestyle expenses that genuinely improve your quality of life, and those that are simply habits, social obligations, or spending on autopilot. For many people in their 40s and 50s, the years ahead will actually represent their highest earning period. Children may be leaving the house, reducing expenses. Mortgages may be largely paid down. Careers are at or near their peak earning years. The window between 45 and 60 is often the single most powerful wealth-building opportunity in an American's financial life, if it is used intentionally. The third principle is consistency over optimization. This is the one that matters most in practice. You do not need the perfect asset allocation. You do not need to time the market correctly. You do not need to identify the next great stock. You need to contribute a meaningful amount of money, every month, into a diversified portfolio of low-cost index funds, for the next 20 years, and not stop when it gets uncomfortable. The investors who retired comfortably in 2020 were not the ones who predicted the pandemic. They were not the ones who moved to cash in February and back into stocks in March. They were the ones who have been quietly contributing to their 401(k)s since 1998, through the dot-com crash and the housing crisis and every other crisis in between, without stopping. Consistency, repeated over decades, is the most reliable path to financial security that has ever been documented. It is not exciting. It does not make for compelling content. But it works. I want to address something directly. because it comes up constantly in the comments section of financial content channels. Do you need a financial advisor? The honest answer is, it depends. And it depends on factors that are highly specific to your situation. For a person with a straightforward financial situation, a 401k through their employer, an IRA, a single income source, no complex estate planning needs, a simple, low-cost index fund portfolio managed with the strategies we have discussed can absolutely be managed without professional help. The tools are available. The information is accessible. And the fee you would pay an advisor can be meaningfully reinvested. But for investors with more complexity, a business, significant taxable assets, a pension, multiple income sources, substantial estate planning concerns, an inheritance, a divorce, the value of a skilled, independent financial advisor can far exceed their cost. The key word is independent. If you choose to work with a financial advisor, work with a fee-only fiduciary. A fiduciary is legally required to act in your best interest, not their own. A fee-only advisor charges a flat fee or hourly rate for their services and does not earn commissions on the products they recommend. These are not the same as advisors who earn commissions on the funds and insurance products they sell you. That distinction matters enormously. The National Association of Personal Financial Advisors, or NAPFA, maintains a database of fee-only, fiduciary advisors. If you decide to work with a professional, that is a good place to start. Even if you manage your own investments, a one-time consultation with a fee-only advisor to review your overall plan and check for blind spots is often worth the cost. A few $100s for a few hours of professional review can identify tax optimization opportunities or risk management gaps that more than pay for themselves. Let us zoom back out for a moment, because this is Fortune Files, and we do not just talk about personal finance. We talk about the global forces that shape it. The decisions you make in your investment portfolio do not exist in a vacuum. They exist in a world of shifting geopolitical alliances, technological disruption, demographic change, and monetary policy. Understanding those forces, at least at a high level, can help you build a portfolio that is more resilient to the shocks they produce. Take demographic change as one example. The United States, like most developed economies, is aging. The baby boom generation, approximately 76 million Americans born between 1946 and 1964, is now in or approaching retirement. Over the next decade, a massive transfer of wealth from this generation to the next will reshape consumer spending patterns, housing markets, healthcare demand, and financial markets in ways that are still not fully priced in. Healthcare, senior housing, home health services, pharmaceutical companies focused on age-related conditions, these sectors are positioned to benefit from demographic tailwinds that are not speculative. They are demographic arithmetic. Technology is another force that every investor needs to at least have a working understanding of. The integration of artificial intelligence into virtually every sector of the economy is not a future possibility. It is a present reality. Companies that successfully leverage these tools will improve margins and productivity in ways that translate directly to shareholder value. Companies that do not adapt will lose competitive position. This does not mean you should overweight technology stocks or chase AI-themed funds. It means that a broadly diversified portfolio of index funds, which includes the companies benefiting from these trends, is already positioned to capture these gains without concentrating your risk in a single sector. Geopolitical risk is the third force worth understanding at a portfolio level. The post-Cold War era of globalization, characterized by open trade, stable supply chains, and relative geopolitical predictability, is being replaced by something more uncertain. Tensions between the United States and China, the fragmentation of global supply chains, the re-emergence of energy as a geopolitical weapon, these forces create volatility. For investors, the appropriate response to geopolitical uncertainty is not to try to predict outcomes. That is a game that even professional geopolitical analysts lose more often than they win. The appropriate response is diversification across asset classes, sectors, and geographies, combined with a portfolio resilient enough to absorb short-term shocks without requiring you to make reactive decisions at the worst moments. A globally diversified portfolio, with meaningful exposure to international developed markets and selective exposure to emerging markets, provides a level of insulation against any single country or region experiencing an extended period of economic difficulty, including the United States. I want to close this section with something that I think gets lost in almost every conversation about money and investing. The goal is not wealth for its own sake. The goal is freedom, security, the ability to make choices about how you spend your time without those choices being dictated entirely by financial necessity. Financial security means being able to leave a job that is making you miserable, not immediately, but eventually, because you have options. It means being able to help your children or your parents when they need it. It means being able to weather a health crisis or a job loss without it being a catastrophe. It means retiring when you choose to, rather than when you are forced to. These are not abstract financial concepts. These are the difference between a life of anxiety and a life of agency. And every dollar you put into your investment accounts today, every automated contribution, every index fund purchase, every resisted impulse to sell during a downturn, is a vote for that kind of life. You are not too late to build it. The strategies exist. The accounts exist. The historical record of what patient, disciplined investing produces over time is unambiguous. What is required is not genius. What is required is not luck. What is required is the decision, made today, and recommitted to every month, that your future self deserves the same care and investment that you give to your present self. That decision is entirely within your power. And it is the most important financial decision you will ever make. If you made it this far, thank you. Genuinely. This is not light content. This is the kind of conversation that most financial channels avoid because it requires patience, nuance, and a willingness to sit with complexity. And you stayed with it. That tells me something about you. It tells me you are serious about your financial future. And that seriousness, more than any strategy, more than any account type, more than any investment vehicle, is what actually predicts long-term financial success. Here is your action plan from today. Open your retirement accounts and verify your contribution rates. Check the expense ratios on every fund you own. If you do not have a Roth IRA and you are eligible, open one this week. Write down, on paper, or in a document, your specific retirement number, your target retirement age, and your current monthly savings rate. And then subscribe to Fortune Files. Because this is the kind of conversation we have every week. Global events, economic forces, financial strategy, explained clearly, honestly, and with real respect for your intelligence and your time. Hit subscribe. Share this video with someone in your life who needs to hear it. Leave a comment below and tell me, what is the one thing from today that you are going to act on first? I will see you in the next video.